SoFi Technologies, ticker SoFi, has exploded as one of the most talked about fintech, digital, and banking stocks. But in 2025, is SoFi stock really the bank of the future or just an overhyped growth story that you should avoid? I'm gonna break all of that down and more in this video. And make sure you stay until the end because I'll give you my personal thoughts at the end of the video. Now first, I wanna give you a quick glimpse as to what SoFi even does and who they are. They were founded in 2011 at Stanford University as a student loan refinancing startup, just to help give grads better rates. They've since become so much more, not just checking and savings and credit card, but also brokerage for stocks, ETFs, options, and even crypto. This isn't a tiny neobank anymore. It's a multi-billion-dollar profitable fintech with tens of billions of dollars in loans and millions of customers. It's run by Anthony Noto, graduate of West Point and MBA from Wharton. He's the former CFO and COO of Twitter, which is now X. And instead of just collecting a salary and stock grants, he's actually been using his own money to buy shares on the open market. Definitely a signal that he believes SoFi's long-term story. Now, before we jump right in and look at the options chain, be sure to subscribe in the bottom right of your corner. I'm putting up a video each and every day talking all about all kinds of different investments with the focus on creating income for yourself on a regular basis. I'm here to help. Thanks for subscribing. Now let's jump right in. Guys, let's just jump right in and take a look at SoFi. So here's a one-year chart that we always start with. This is my Thinkorswim platform. And SoFi right now is trading at $27.13 per share, as we can see here. So because of its low cost, it can be a very good choice for your trading account, but you'd have to make that own determination yourself. We're gonna take a look at the options chain. So first of all, we definitely notice that they offer weekly options, which is great because we wanna create weekly income for ourselves. Now, because today is Thursday, the 11th, instead of looking at tomorrow, we're gonna look at the 19th. So it's about 1 week out. We want to look at a few things. We see the implied volatility is in the 50% range, which is very good. And we also see open interest and volume looks very healthy, good as well. Now, usually on this channel, I really focus on two strategies, selling puts and selling covered calls. In my view, the best thing to do is always to start with selling a put because you're keeping your money in cash and you're only buying the shares if the stock drops in value. So you get it at a discount. Then, if and when you have to buy the shares, you turn around and sell a covered call and make money again. So let's walk through selling a put together. Now you get to choose the strike price. The strike price is the price at which you're comfortable buying the shares if the price drops below that value before the contract expires. So you want to consider the size of your account and what your intentions are with your trading. Now, the closer the strike price is to the price where the stock is trading, you're going to get paid more money for that. And that's logical, right? And we can also look at the delta. The delta is the statistical likelihood that the stock will drop below that value before the contract expires. So the lower the delta, the more conservative the trade is. But you don't get as much money. So I'm going to walk through a few different scenarios with you. Let's say you are a big believer in SoFi and you're okay buying 100 shares if you had to buy them. Well, in that case, you might want to go close to the money, such as a $27 put. And that last traded at $80. And we can see the spread between the bid to ask. $80 bid, $81 ask. That means if you put an order in to sell at $80, it will automatically be filled. And when there's a tight spread like that, 1 penny between the two, that means that there's a lot of people trading that particular contract. So it's a good sign for you. And as you can see, we can see 20,000 in open interest and over 3,000 in volume. Very, very healthy. Now, we always want to calculate our rate of return. If I was to sell a contract at $80 and I was putting up $2,700 in capital, not using margin, assuming that we're putting up all the money, we're making almost a 3% rate of return. Now, this is about a week's time, so we're going to multiply by 52, and we're going to get an annualized rate of return of about 154%. Very, very high because the volatility is pretty high, and we're choosing a strike close to the money. So that's to be expected. Now, let's say we go a little bit lower. Let's say we go to a 25.50 strike, and that has a 21 delta at the moment. Now, you will notice that the delta will adjust, just like the prices adjust as the day moves on. This last traded at $30. So we're going to divide $30 into 25.50, which is the capital needed, and that gives us our rate of return for about 1 week's time. And now we're going to multiply by 52, and that gives us a little bit lower rate of return of 61%. Now, I wouldn't say 61% is anything to sneeze at, because it's still a very high rate of return. Let's go even lower on the strike price. Let's, for example, use a $24 strike, and this currently has a delta of 10, meaning it has a 10% likelihood that the stock is going to drop before $24 before next Friday. Now this last traded at $12, which doesn't sound like a lot of money, but let's take a look at the rate of return in percentages. If I'm going to divide $12 into 2,400, which is the capital needed, it gives us about a 0.5%. And if I did a trade like this every week, I would be making about 26% on my money. Still not bad. Now I'm going to give you another idea because maybe you already have SoFi stock. Now if you already have SoFi stock, it's always good to sell a covered call against it because it gives you cash flow. If you only have stock and you don't sell calls against that stock, it's kind of like having a rental property but not having any customers and not taking any income in. I mean, you could get capital appreciation on the stock going up, but that's always going to be a paper gain. And I don't know about you, but I prefer cash in my pocket over a paper gain that I only see on a computer screen. So depending on how much you own the stock for, you want to consider that in choosing a strike price if you're selling a covered call. Now, a covered call means that you're committing to sell your shares if it goes higher than the strike price before the contract expires. So you always want to choose a strike price that's higher than what you paid for the shares. Otherwise, your shares could get called away and you would lose money, and you don't want to do that. Now, let's say you like SoFi and you don't mind holding on to it for a period of time. Well, you might not want to go super close to the money. You might want to go a little bit further away. So let's say you want to sell a $29 covered call, and that has a delta of 22. And right now, that's trading at $27. Now, you could calculate the rate of return. So for example, if you're taking in $27, and then it depends on how much you own the shares for. So let's just give an example. Let's say you purchased the shares for $27. You would divide by 2,700, and that gives you a rate of return of 1%, and you'd multiply by 52 to get an annualized rate of return of about 52% per year on your money. Now this is technically about 6 days of time, so a little bit longer than a week, but I'm trying to simplify the math for illustrative purposes. Now the great thing about covered calls is this: you can't lose money on a covered call because you already have the stock, right? So you already have the volatility and the paper gain or paper loss that stock fluctuation gives you. But when you sell a covered call, you get paid a premium, and you keep that premium no matter what happens. It doesn't matter where the stock goes, you get to keep that cash. And one of two things happens when the contract expires. If the stock is higher than your strike price, your shares will be called away. You'll have made the premium on selling the call, and you'll have some capital appreciation on the stock as well. And if the stock closes below your strike price, your shares won't be called away, so you'll keep your shares. You'll keep the price that you were paid on selling the option, and then you can sell another covered call next week. Covered calls are one of the best things in investing. Now, I told you guys to stay until the end, and I'm going to give you my opinion on SoFi, and I've personally traded this ticker myself. Now, I'm not here to recommend any particular stock because those are choices that you need to make because it's your money and your own responsibility. But me personally, I like SoFi. I like it for a few different reasons. I like it because it's a big profitable company and it has a great growth story. I like the way it started with the intention of helping grads get better rates. I like the CEO who runs the company, and I love the fact that he's buying shares of stock on a regular basis with his own money. I like the implied volatility in the 50% range. I like how it's talked about a lot and it has a lot of open interest in volume and traded quite often. And I really like the rate of return. So me personally, I'm putting my money in SoFi. But again, that's not a direct recommendation for you. So what did you guys think of that video? Pretty cool, huh? Let me know in the comments. Are you a believer in SoFi, or do you prefer a different ticker? Let me know what you want me to do a video on so I can add it to my list. And be sure to send this video to a friend of yours who might be looking for something to trade. Thanks for watching, and happy trading.